Good afternoon and good morning, depending on your geography. This is David Burton. I'm a partner at Norton Rose Fulbright in the project finance group and focused on tax planning for energy transactions. We appreciate everybody joining and taking the time, and we hope you're all doing well. We're going to go through this webinar today on capital accounts in tax equity transactions, and I think it'll be informative and useful. And I'm very pleased to be presenting this along with my two co-presenters from Pivotal 180, Dan and Hayden. So they have done a really excellent job developing this webinar video technology, and I think you'll find it interesting and a little bit more dynamic than other webinars you may have participated in. I'm going to let Dan introduce himself. He is in Cape Town, South Africa at the moment, so there may be a little bit of a technical issue, but Dan, please introduce yourself and start.
So welcome everyone to this webinar. We're delighted by the level of enthusiasm for issues of tax. We're completely overwhelmed with this. As David mentioned, I'm dialing in from Cape Town, South Africa, which completely apt for a webinar about renewable energy, is right now suffering load shedding, where selective neighborhoods are shut down from the grid. So I am actually, I have no electrical power and I'm relying on battery and may lose everyone. My background is as a private equity investor. I founded the renewable energy investing business at GE Capital and used to work together with David on tax equity transactions. And so some of that knowledge of transaction experience will be self-evident here. We have attempted to put together something that we think will be really valuable for you, in that it starts with the theory, broken down piece by piece into something that hopefully will be digestible and straightforward, and then moves into numeric examples so you can actually see quantitatively how everything moves through the tax capital account. And hopefully this will be a skill set that is actionable and useful. And with that, why don't I turn it over to Hayden to take the reins and set us off in motion.
Thanks, Dan. So likewise, really happy that everyone could join us today. It's a slightly longer webinar, but it's a relatively big topic. So we're happy you're here. My background, I'm a little bit newer to the US as opposed to Dan and David. My background has been in advisory almost my entire career, with a period as an engineer early on. And I'm sort of, I guess, a specialist in some ways in terms of financial modeling. And I'm a founder together with Dan at Pivotal 180. And Dan and I also teach a course together on renewable energy at Columbia University. As Dan mentioned and David mentioned, so this is a little bit different in that we've pre-recorded pieces of the webinar to make it a little bit more dynamic, and hopefully you enjoy the new format. If you do have any questions at any point in time, there is a opportunity to post questions. And we will also be pausing at various times through the webinar to speak with you and let you ask questions. The webinar will kick off first, just going through, make sure everyone's up to speed with the production tax credit, the investment tax credit, and the benefits derived from depreciation and transactions. After that, it will get into the capital account. So we hope you enjoy this. And with that, I will now share the video portion of it.
There are three main tax-based incentives that are provided to investors in U.S. renewable energy projects, and those include accelerated tax depreciation, called Modified Accelerated Cost Recovery, or MACRS, production tax credits, or PTC, and investment tax credits, or ITC. MACRS accelerated tax depreciation is a tax deduction which reduces the taxable income and, by extension, the tax cost. The most frequently applied depreciation schedule in renewable energy is 5-year MACRS, which typically applies to about 90% of the depreciable assets of a project. The other project assets would typically follow a longer lived depreciation schedule. For instance, you might use a straight line schedule for owned real property other than land, like buildings. So you can see on the screen, the 5-year schedule is 20% in year 1, 32% in year 2, 19.2%, 11.52% in year 4 and 5, and finally 5.76 in year 6. And so if you're looking at it kind of funny, because it's supposed to be a 5-year schedule, know that it extends for 6 calendar years because there is something called the mid-year convention. We assume we started in halfway through year 1. For most wind and solar projects, the 5-year maker schedule creates negative taxable income for the first several years of an investment's life. And when you hear negative taxable income, think losses. So if a corporation owns other profitable businesses where it can use the tax losses from a renewable energy project to offset taxable income on those other businesses, that's great. But if it doesn't, a corporation can, if it lacks any other kind of sources of taxable income, it can carry forward the net operating losses indefinitely and use those losses to offset taxable income in the future. On a standalone basis, the renewable energy project itself usually becomes tax positive after the end of the 5-year maker's depreciation schedule. So let's say we had an EBITDA, which is earnings before interest, tax, depreciation, and amortization, of $500. And assuming there's no debt, so there's no interest expense, and no depreciation, our taxable income, which you might think of as the earnings before tax, or you might call it EBT, it's just our EBITDA, which is $500, and we pay tax at the current tax rate. So with a federal corporate income tax rate of 21%, the tax would be 21% times 500 of income, or $105. Now, if instead we had a project that generated $100 of depreciation, we would reduce our taxable income, or reduce our EBT, down from 500 less 100 of depreciation, so it's now 400 in income, and the project will pay tax on 21% of 400, which equals 84. So this $100 of depreciation will reduce our tax payments from 105 down to 84. So that depreciation expense saved us $21 in tax cost. You can think of the savings as the 21% tax rate multiplied by the $100 of depreciation expense, or more broadly, the tax benefits of depreciation is going to equal whatever the depreciation expense is multiplied by the prevailing tax rate.
It is worth noting that since the Tax Cuts and Jobs Act, which was passed in 2017, projects do have an option to fully deduct their eligible costs in year 1 rather than use the 5-year maker schedule for depreciation purposes. This is called bonus depreciation, which has been available at various percentages since 9/11. On a standalone basis, this appears like a huge benefit. We have seen more deals utilize this benefit, but is often not used in wind PTC transactions and not in some solar ITC transactions due to capital account issues, which we will explain later.
The production tax credit, often abbreviated as PTC, is the predominant tax incentive for wind projects in the US. And it's available for the first 10 years after the wind farm is placed in service. But unlike depreciation, which is an expense that reduces our taxable earnings, tax credits directly offset our taxes due. So at a 21% federal tax rate, $1 of depreciation would reduce our tax bill by 21 cents. However, $1 of tax credit would reduce our tax bill by a full $1. The credit as of the 31st of December 2019 was worth 2.5 cents per kilowatt of electricity that is generated. The credit was introduced back in 1993 as 1.5 cents per kilowatt hour, and every year since then, the Internal Revenue Service has released a bulletin with the amount of inflation to be applied. And as of 2019, this inflation has accumulated to bring us up to the 2.5 cents. The production tax credit can be carried forward for 20 years into the future and then also 1 year back. So just like net operating losses, you can accrue tax credits and use the benefit later. And the PTC is being phased out. If your project started construction in calendar year 2017, that PTC amount is 20% less than 2.5 cents per kilowatt hour. Instead, you would receive 80% of that at 2 cents per kilowatt hour. If you started in 2018, it's 40% less than 2.5 cents per kilowatt hour, and in 2019, 60% less. Until the December 2019 tax extenders bill, the PTC was fully phased out for projects starting construction in 2020, this year. But the recent tax extenders bill allows projects that start construction this year in 2020 to receive 60% of the full PTC value, or 1.5 cents per kilowatt hour, but then fully phased out the credit for projects that start beyond 2020 from 2021 and beyond. And as a result of this step down in PTC, there's been this rush to start construction as soon as possible in order to maximize the tax credit. The IRS has offered extensive guidance defining precisely what it means to start construction. And in our observation, most of the large wind projects commissioned in 2019 were deemed to have started construction in December 2016 or earlier, which means they are entitled to the full PTC value with no phase out. And this would mean that projects commissioned at the end of 2019 actually started construction back in 2016 with 3-year construction periods. From what I know of wind, it certainly doesn't take 3 years to build a project. So I wonder how this makes sense, David.
This comes down to guidance published by the IRS, which established 2 methods for determining the start of construction date. We won't cover the full subject, but here is a snapshot of what kept me the busiest at the end of last year. There is a physical work test, which means that the project has begun work of a significant nature. This can mean a lot of things, including excavation for the foundation, setting anchor bolts into the ground, or pouring concrete pads. It can also be physical work on a custom-designed step-up transformer for the project, or even construction of roads that are to be used for operations and maintenance purposes. But if the project isn't ready for physical work, there's a second way to establish the start of construction. You can meet a safe harbor by incurring 5% or more of the total cost of the facility. You can pick one of 2 special rules, like a kid picking from 2 desserts. You can only pick one of the special rules. First, you can opt to take delivery of the purchased components by the end of the year in question, and then pay for them with financing from the vendor over time. And the second special rule, or the second dessert option, is you can pay for them by the end of the year, and then the vendor has 3.5 months to deliver them to you. But our work doesn't stop here, so to speak. It's not enough just to start construction. You can't just pour a foundation or build some roads and then wait 20 years before you start generating energy. The IRS imposes a continuous construction test if you're doing work of a physical work, or a continuous efforts test if you've opted for the safe harbor. But it can be hard to define continuous. Does the construction team have to work on weekends and holidays? Can they take a break for a few months? How about a few years? Investors were quite concerned about the potential for ambiguity, so the IRS issued guidance establishing a continuity safe harbor. This rule says that you will be deemed to have engaged in continuous efforts provided that the project is built within 4 calendar years after the start of construction. Over the past several years, I've done a tremendous amount of work with developers, assisting them with start of construction strategies and the associated documentation. So even though the PTC is gone for projects that start construction after 2020, investors will be receiving tax credits for projects that achieve COD well into 2024 and possibly later if the project can provide continuity for the whole time.
Now, the most important thing to remember about the PTC is that it is production-based. It's quantified in terms of cents per kilowatt hour, So the amount of tax credit that you receive is directly proportional to the amount of electricity that you generate. If you produce less energy than forecasted, you will generate less tax credits. The other common renewable energy tax credit in the US is the investment tax credit, or the ITC. And the investment tax credit is the predominant tax credit for solar. But actually, wind projects can also choose the ITC in lieu of the production tax credit. And just like the PTC, the ITC is also a dollar-for-dollar offset of taxes due. So whereas the production tax credit is earned over a 10-year period of time, the investment tax credit is an upfront credit. And the credit is received when the project is placed in service. And given that most companies pay their estimated taxes every quarter, the benefit of the ITC would typically be enjoyed at the end of the quarter in which a project is placed in service. The amount of the ITC equals 30% of the eligible energy property. So if my project has $100 million of eligible property, I would receive a $30 million tax credit immediately after the commercial operations date, or maybe more precisely, in the first quarter in which I pay estimated taxes after the project is placed in service. One of the reasons that it's important to get very good tax advice is that it can be hard to determine exactly what property is eligible for the ITC and what is not. So solar panels and racks and wiring is eligible, but the fencing around the site, building improvements, and components that come after the step-up transformer are not eligible. Because the ITC is an upfront credit, some investors think of it as if they're able to buy a $100 asset for only $70, net of the tax credit. And when you think of it that way, it doesn't really seem totally fair for the investor to benefit from $100 of depreciation expense for something that effectively only cost them $70. And so sometimes when the government gives, it also takes away. If you elect to take the ITC, you're also required to reduce your depreciable basis by 50% of the ITC amount. So the assets eligible for a 30% investment tax credit are subject to a depreciable basis adjustment of 30% divided by 2, or 15%. Thus, assets valued at $100 are only entitled to $85 of depreciation. Investment tax credits can be carried forward for 20 years or back for 1. And unlike the PTC, this isn't a credit that's based on the amount of energy that's generated. So there's an additional rule that projects must remain in service generating energy for 5 years. And the rule works such that if you take the project out of service within this 5-year window, which is called the recapture period, you will need to pay back some of the tax credit. The tax credit basically amortizes on a straight line basis. So if you took the project out of service after 1 year, you would need to pay back 4/5 or 80% of the tax credit. The ITC is also scheduled to step down for projects that start construction after December 31st, 2019. For projects that start construction in 2020, they will get a 26% ITC. In 2021, they'll get a 22% ITC, and from 2022 and thereafter, the credit stays at 10%. Now, the ITC for solar isn't scheduled to fully phase out like the PTC for wind, and the ITC for solar was not affected by the 2019 tax extenders bill.
An important distinction to the PTC is that the ITC is not a function of how many kilowatt hours you generate. It's just a function of how expensive your project is. So a $100 million solar project built in Barrow, Alaska, which has 2 full months of darkness in winter, is entitled to exactly the same tax credit as a project built in sunny Phoenix, Arizona. Makes you start to wonder what we're really trying to incentivize here. And although we have been focused on solar, wind projects may also elect to use the ITC in lieu of the PTC. The equity investor can decide, but the ITC for wind projects phases out over the same schedule as the PTC for wind.
So it's not like opting for the ITC will enable wind projects to get a tax credit if they start construction after December 2020.
So we've had a number of good questions, and I might pass across to David to answer these. There's sort of three that he's got, and he's happy to answer. So David, I'll pass to you.
Okay. Thank you, Hayden, and thank you for the questions. We like the interactive nature of this format. So we've got one question of, does curtailment lead to lower PTCs? Yes, it does. So to qualify for the PTC, the energy has to not only be generated, but it has to be sold. So if the energy is not sold, there's no PTC. So curtailment does lead to it. So curtailment is something that tax equity investors look at quite carefully and underwrite with considerable analysis, because it does mean for reduced PTC. Obviously, for the ITC, which is based on cost, curtailment's not a problem. So long as it doesn't go on for months and months and months and months and cause you to think, well, maybe the project's been removed from service, but that's never happened in history. Then we had a question about interest expense deduction and the limitation on interest expense deduction and how that applies to tax equity funded renewable energy projects. So a very interesting question. And the answer is that it is a constraint on tax equity funded renewable energy projects. It does apply. And in fact, there's a threshold for most businesses, and tax equity partnerships do not qualify for that threshold because the law deems them to be tax shelters. That's a defined term in the tax code, and tax shelters do not qualify. So even if you have a small project that wouldn't otherwise be over a gross income dollar limit to trigger this rule, you're still subject to it if you're building a tax equity partnership. I guess the big thing though to keep in mind is that majority of tax equity projects are done without project level debt, and rather the sponsor borrows back leverage, and so therefore the tax equity partnership itself, if its sponsor back leverage, is not putting the interest deduction on the tax equity partnership's tax return. So therefore there's nothing for this to apply to, and instead that interest is tested for deductibility at the sponsor level. So as a practical matter, if you're doing back leverage, this is not going to come up for the tax equity partnership or the tax equity investor, although the sponsor itself may be facing limits on how much interest it can deduct. And then finally, there's a question about claiming PTC on projects constructed in 2018 or 19 that did not take the PTC at that time. So I've yet to come into, run into a wind project that didn't, in the US, that didn't claim some tax credit. So I'm assuming if it didn't take the PTC, then it claimed the ITC, in which case it cannot now switch back and claim the PTC. So it took the ITC. If somehow it really didn't take a tax credit and it really didn't claim the PTC or ITC, it could start claiming PTCs, but you only get PTCs for 10 years since you were placed in service, even if you didn't claim the PTC. So, if it was placed in service in 2018 and they start claiming the PTCs in 2020, that 10-year period is going to run out in 2028 instead of, so you're only going to get a shortened PTC period. So that's, I'm suspicious about this question because I'm not sure I've actually seen this or why this would come up. There is something called repowering, whereby if you repower a project and 80% of the value is new equipment, you can then requalify it for tax credits. So that is one way where existing projects through repowering with 80% of the value then being attributable to new equipment could qualify for tax credits despite having claimed them before. But that's a complicated topic that you should raise with your tax advisor if you're thinking about that. Hayden, do you want to answer other questions?
Let me just to keep moving, I'll answer one more quickly, and if there's other questions that answer, we can continue later. One of the other questions here is any recommendations on supplemental reading covering the basics of what we just talked about. Obviously, if you're subscribed to the Norton Rose newsletters, etc., that's one way. Pivotal 180, we also have a number of materials we will distribute, but I can also recommend a book that's relatively new called Renewable Energy Finance, Theory and Practice, written by Santosh Raikar from Silver Peak, and also Sebron Adamson, I think it is the other writer for that, and that's actually a pretty good book to read. But with that, I think we should move on with the video, and any other questions we can come to or we'll answer via text.
To better understand the impact of the tax credits and depreciation, let's take a look at the profile of a cash flow within a wind project that elected to take the production tax credit. And as we'll be taking you through a model with sample cash flows, let's just quickly get oriented to the assumptions about the project. And now recognize we're using very simplified round numbers for ease of example. While they approximate a real project, don't assume that they're representative of what you'd actually see in the field today. Our project has an operating life of 35 years. Its capacity is 72 megawatts. Its installed cost is $100 million, nice round number, and the project is forecasted to generate 225,000 megawatt hours per year, which translates to a net capacity factor of 35.7%. With a PPA tariff of $22 per megawatt hour and no escalation over time, the revenue would be forecasted to be an even $5 million per year. Again, a nice round number. And let's just say the operating costs are forecasted to be $1 million annually, also assuming no escalation over time. So when we look at the operating income of the project, with $5 million of revenue less $1 million of costs, we have $4 million in EBITDA. And just think about this project in the example as the most boring and predictable project in the world. Okay, the EBITDA is entirely flat and nothing changes from year to year. We've also structured debt service to deliver a 1.4x debt service coverage ratio, assuming a 5% interest rate. And for ease of example, we've assumed that 100% of the project is eligible for depreciation on a 5-year maker schedule. To calculate the line here called tax benefits or costs, we look to the taxable income and multiply it by the tax rate, which we're assuming to be the federal corporate tax rate of 21%. And during the years when the project is generating losses or negative taxable income, taxes are actually a benefit. An efficient taxpayer, meaning a large corporate with an existing taxable income base, someone like JP Morgan or Wells Fargo, they can use those losses immediately to offset other income that they may have, which obviously results in less tax cost. The production tax credits for our project are calculated based on 10 years of production and a PTC of $25 per megawatt hour or 2.5 cents per kilowatt hour. Moving from income to cash flow, from the standpoint of after-tax cash flow to the investor, we start by taking our EBITDA, and we will first subtract interest expense and debt principal repayments in order to calculate the cash distributions made to equity. And we add that to our taxable benefits and our tax costs, plus our PTCs, in order to derive the after-tax cash flows to the equity investor. And now remember how we started with the most boring project in the world. The operating income, or the cash available for debt service, and the debt service was exactly the same in every year. So now just look at the after-tax cash flow. That line is anything but flat. It's all over the map. And the only thing that's driving those variations is tax.
In terms of scale, it is worth noting that over the first 10 years of the project, only 15% of the after-tax cash flow is derived from cash distributions, 19% from the tax shield associated with tax losses, and 66% from the tax credit. Over 80% of the after-tax cash flow to the investor is from tax incentives. And this mix does change once we look beyond the initial 10 years, but still, tax is a major driver of the financial returns from renewable energy investments. Because there is a time value of money, it's also critical to be able to use the tax credits and tax losses immediately when they are incurred. Efficient taxpayers can use losses from renewable energy projects to offset positive earnings from other profitable businesses and use tax credits to reduce their tax bill. However, most developers of renewable energy don't have tax capacity, so they are left with a few options. Number one, they could carry the losses and the tax credits forward until they have positive earnings, which is inefficient. Or two, they could sell the project to someone who can use the benefits. Or three, they could enter into a tax equity partnership with an efficient taxpayer, whereby the efficient taxpayer becomes an equity investor in the project, providing capital which is largely repaid by tax benefits. And this is all because there is an NPV benefit to using the losses today versus accruing them and using them later to offset your taxes.
I'm here to help demystify the partnership allocations and rules about capital accounts for tax equity partnerships. But before I get too deep into the weeds, I'd like to provide an overview of how these deals are typically structured. Most commonly, a renewable energy project, like a wind farm, is owned by a limited liability company that is taxed as a partnership due to having more than one member. Those members are the sponsor and the tax equity investor. We refer to these LLCs as partnerships for the sake of simplicity. Partnerships are commonly designated by triangles on entity diagrams. The idea is that taxable income and loss, as well as tax credits, are passed through the partnership to the ultimate owners. So the partnership itself is not a taxpayer. The partners in a tax equity partnership typically include the sponsor, which is oftentimes also the developer, and the tax equity investor. The tax equity partnerships most often do not have debt at the project level. This is not to say the investments are unlevered. Instead, we often see a structure known as back leverage, in which a lender lends to a special purpose company owned by the sponsor, which in turn owns the sponsor's interest in the tax equity partnership, and the lender is repaid solely from the cash flows that the sponsor receives from the tax equity partnership. It's called back leverage because the lender is not lending to the tax equity partnership itself, and the lender has no security over the project assets. The lender security package is essentially just the partnership interest owned by the sponsor. To understand the tax equity structure, you need to be familiar with some important rules regarding U.S. partnerships. Under U.S. partnership tax regulations, each partner's entitlement to a share of the partnership cash flow and taxable income, or tax credits, does not need to be static. Allocation percentages are permitted to vary over the time, with allocation flips based on predefined triggering events such as achievement of a target IRR or reaching a specific date. In any given year, a partner's right to cash distributions does not need to be proportional to its allocations of taxable income or loss, which does not need to be proportional to its original capital contribution to the partnership. While partners have much latitude to negotiate a variety of allocation structures, there are several rules imposing limits on the way in which these allocations must work. Most notably, first, 100% of the partnership taxable income each year must be claimed by someone. Second, no partner can take losses, meaning tax write-offs, more than they have invested, subject to certain exceptions which will be discussed later. For example, if you invest $100 million of capital, you have $100 million of capital investment and you aren't permitted to take losses exceeding this $100 million. Third, the transaction must have substantial economic effect. This is governed under Section 704B of the tax code, which requires first and foremost that the capital accounts for each partner are maintained in accordance with a set of technical tax rules, some of which are intuitive and some of which certainly are not. We will develop these accounts together and cover some additional rules as we get to them.
David mentioned that in any given year, a partner's right to cash distributions doesn't need to be proportional to its allocation of taxable income or loss, which doesn't need to be proportional to its original capital contributions or its basis in the partnership. These partnerships are all about disproportionate allocations. For wind, the allocations are often applied over two distinct periods called the pre-flip and post-flip period, which are shown here on our diagram as period 1 and period 2. In period 1, the pre-flip period, the tax equity investor on the right-hand side takes 99% of the taxable income or the loss and 99% of the tax credits. The remaining 1% is going to go to the sponsor. Why a 99-1 split?
Well, tax equity wishes to take as much of the losses and tax credits as possible, but they can't take 100%. This relates to a safe harbor ruling from the IRS stating that the developer needs to maintain a minimum 1% interest in all partnership items, including the tax credits. A common cash sharing arrangement in period 1 is 20% of a tax equity investor and 80% of a sponsor, but there is considerable variations in the market with respect to these allocation levels.
As the PTC is earned over 10 years and constitutes such a major part of the financial returns, the tax equity investor will want to maintain this 99% of tax attributes until the end of year 10. But after year 10, the allocations will typically flip to a different percentage, which puts us into period 2. This flip is usually triggered by the tax equity investor achieving an after-tax IRR or hurdle rate, which is expected to occur around the end of year 10. If the IRR hurdle is not achieved, the flip will typically be delayed, and the tax equity investor may receive an even greater proportion of the cash distributions from the partnership. Now, remember that Maker's depreciation is for 6 years, so the project will likely have positive taxable income from year 7. The tax benefits are exhausted at this point, and the partners will have to pay income tax on any earnings allocated to them. The sponsor really doesn't need the tax equity investor anymore. So in period 2, the allocations flip such that the tax equity investor receives 5% of the tax attributes and 5% of the cash distributions, and the sponsor receives 95% of both the tax attributes and the cash distributions. The question really is, why 5%, David? Surely the tax equity investor would rather just exit the partnership.
The same safe harbor ruling that I just talked about states that the tax equity investor must have a minimum interest in the partnership income and gain equal to 5% of its largest allocation percentage of profit and loss during its ownership of an interest in the partnership.
Solar works a lot like wind, except there's a little more variation because tax equity investors approach things a bit differently. The main difference is that solar projects effectively receive all of their tax credit in the first quarter after the placed in service date, rather than receiving it over 10 years like the PTC. So after the first quarter, the only remaining tax benefit is the depreciation expense, and that will run its course by the end of year 6. So in solar deals, the flip is sometimes scheduled to occur in year 6, and in other solar deals, the flip is based on a target yield for the tax equity investor, basically an after-tax IRR. Due to the front-loaded timing of the ITC, some tax equity investors opt to be allocated 99% of the tax attributes in year 1, and then only 67% of the tax attributes thereafter. And this structuring of the allocations is to avoid some issues in capital accounts, which we'll focus on in just a few minutes. For solar deals, the percentage of cash distributions allocated to the sponsor are often a bit greater than they are for wind.
In terms of the capital stack of the project, they vary substantially based on the project attributes. But as a broad overview, in wind partnerships, 50 to 65% of the capital is typically provided by tax equity, with the sponsor and the back leverage debt providing the remaining amount. And there is also a structure called pay-go, which works a little bit differently because capital contributions are made over time. And we will cover this in Pivotal 180's next webinar with Korn Resnick. In solar partnerships, 40 to 55% of the capital is typically provided by tax equity. This is much less than the 50 to 65% for wind, as most solar projects generate far fewer tax credits than wind projects, at least with a reasonable capacity factor. And remember, the sponsor typically funds part of its investment through back leverage.
For a wind project, the PTC accrues over a 10-year period, regardless of the ownership of the project. So if you buy a 9-year-old project, you're entitled to the 1 remaining year of PTCs. Similarly, if you invest after the project has been operating for a month, you are still entitled to 9 years and 11 months of PTCs. Solar is different, as is a wind project that would elect the ITC. The ITC is available only to the taxpayer that owned the project on the date the project is placed in service, which the IRS views as a specific date. So if you invest a day too late, there is technically no ITC for you. But what if an ITC project is owned by a partnership? The ITC is allocated to partners based on their allocation percentage in effect when the project is placed in service. But how much does a tax equity partner have to have invested on the placed in service date? The IRS answered this question in the context of rehabilitation costs for historic buildings, which are also eligible for the ITC. For these historic buildings, the IRS ruled that the tax equity investor must have invested 20% of its total investment on or before the placed in service date. Since renewable energy projects also claim the ITC, and there's a lack of guidance for renewable energy, the renewable energy industry looks to this 20% rule that's from the historic building ruling. So for renewable energy, we want to have the tax equity investor have made 20% of its investment, at least that, on the date the project is placed in service.
We've mentioned this private letter ruling a few times, and I think it's interesting to touch on it since David and I were actually closely involved in its origin. Prior to 2005, tax equity allocation structures were much less standardized than they are today, and different investors displayed a wide tolerance for a variety of allocation percentages and other features that are no longer common. The change was initiated by GE Capital, which pursued a private letter ruling from the IRS, seeking acknowledgement that the IRS would respect certain allocations for a tax equity investment in a wind farm that David and I worked on together. GE was fortunate enough to be issued a favorable ruling in October of 2005, and that ruling was released to the public by the IRS in March of 2006. And when word got round that GE had received basically the blessing of the IRS, other investors began requesting private letter rulings of their own and initiated Freedom of Information Act requests so they could get sufficient background data to mimic the structure on this GE deal. The IRS actually issued GE a second ruling in November of 2005, but the IRS refused all subsequent requests for private letter rulings blessing tax equity partnership transactions, and instead they ultimately issued safe harbor rules in 2007, and those safe harbor rules were principally in accordance with the original structure that GE had proposed. So in a lot of ways, the origin of the market standard for tax equity partnership flip structures is an accident of history that was largely determined by what GE Corporate Tax, what Dave Burton and his colleagues working there thought was a reasonable thing to request from the IRS at the time.
So there's a couple more questions. So I'll just take a quick pause, and if you've got any questions that come to your mind, please do put them up. There was a further question regarding 163J, which is around the interest deductibility limit. The person that raised that, that's a good question. Actually, David's going to add a response to that on his on an upcoming blog of his. So pay attention to that, because it is an important topic both in renewable energy and across an infrastructure as well. Another question that's really good, but it's a huge question, is asking around what the risks are to a project company or other partners if there's back leverage. And to give just a little bit of clarity on this, the project company is distributing cash based on this cash sharing agreement between the tax equity investor and the sponsor. And some of that cash, or the cash that's going to the sponsor, is going first into the holdco, and that holdco has to pay debt service first to the lender, after which it gets cash up to the ultimate sponsor. I think the important takeaway really from the first takeaway is that the lender's security is no longer over the project assets itself. It's over, the lender's security is the sponsor's partnership interest. So it does drastically change the risk profile to the lenders. And to answer that question more fully, we're doing the Pivotal 180 is doing a 2-part webinar series with Korn Resnick. The first one is on the 25th of March. The second is to be confirmed. The first one will cover the sensitivities and scenarios around this sort of structure. And the second one will focus on exactly this question. What is the risk to sponsor, tax equity, and the lenders in typical renewable energy transactions here? It's a good question. It's a big one. So we'll have to park that to another day. And with that, we will continue with the presentation.
Now that we understand the broad deal structure, cash benefits, tax benefits, and allocations, we can get into capital accounts. And we will start by defining a capital account. A capital account tracks the carrying value of an investment. In our case, we will focus on tax capital accounts. You can think of this as the tax value of the investment of each partner. A typical tax capital account works in a manner quite similar to the equity method of accounting under US GAAP. We start each period with an opening balance, after which we add the cash investment and the income from the project. Or if there are losses, those are subtracted. And then we decrease the balance by the cash distributions to get to the closing balance for the year.
We will start with a capital account for the whole partnership of our hypothetical wind project. But before we do that, we need to recalculate the tax benefits or costs and cash flow to the partnership. The project has revenue of $5 million and costs of $1 million, and EBITDA of $4 million per annum for a total of 35 years. And the sponsor has employed back leverage, so there is no debt at the partnership level. The only deduction from EBITDA is tax depreciation, which is the total capital cost of $100 million, leaving our taxable income at the sum total of $40 million over the project life. And we still have losses over the first 6 years due to depreciation. But the losses are slightly smaller than with our earlier example, as we are not deducting interest expense. The tax benefits or costs are calculated by multiplying the taxable income or losses by the tax rate times -1. And we will assume that there are no state taxes. So we will only use the federal tax rate of 21% multiplied by -1. So in year 1, we have 21% times losses, or -16 million, times -1, which equals 3.36 million. And in year 2, it's the same formula with a total tax benefit of 5.88 million, and so on and so forth to the end of the project life. The production tax credits are the same as earlier at 5.63 million per annum and ending in year 10. The tax benefit or cost is the sum of our tax benefits and PTC in year 1 equaling 8.99 million. And there is the one formula copied across the whole row, and again the total is 47.85 million. Note that the tax benefit becomes a cost in year 11 once the PTC ends in year 10, and all of our depreciation has already been exhausted back in year 6. And the investors of the partnership now owe taxes from year 11 until the end of the project.
Given that there's no debt service for our project, the partnership cash flow from the project is simply its EBITDA, given that we're assuming that EBITDA equals the cash flow that's available for distribution to equity. So the tax benefits or costs were calculated earlier at $47.85 million. So the total after-tax distributions, assuming that we are an efficient taxpayer, are the sum of these, or $187.85 million, as you'll see on the screen. In year 11, all of the tax benefits have now been absorbed, and the after-tax cash flow is just going to be our EBITDA less the 21% tax cost on that cash flow. So to summarize this, the total partnership taxable income or loss is $40 million over the life of this project, and the EBITDA is $140 million over the life, and we will use these numbers to start building an account for the total project or partnership year by year.
In year 1, the investors invest $100 million, or the total construction cost of the project. We add our taxable income in year 1, which is minus $16 million, given that we have a loss. And then we deduct from this our cash distribution of $4 million, leaving us with a balance of $80 million at the end of year 1. Year 2 starts with an opening balance of $80 million. That's the balance at the end of year 1. And the investment occurred in year 1, so there's nothing to add here in year 2, but we do again take a loss of $28 million and bring down negative $4 million of cash distributions to end up with a closing balance of $48 million. The losses and distributions are reducing the basis of our capital account. In year 3, 4, and 5, we follow the same trend, with the capital account balance continuing to reduce in each year. But in year 6, we start with an opening balance of $5.76 million, and we bring down $1.76 million of losses. The losses have been declining in value due to the maker's schedule. And we also deduct $4 million for the distribution, resulting in a $0 capital account closing balance. We have reduced our tax basis to 0. And so we come across to year 7 and we start with a 0 balance. We add a $4 million taxable income and we deduct from that a $4 million distribution, again ending with a 0 balance. This continues until the end of the project, with the distributions equaling the negative of the taxable earnings. Stepping back for a second, what this really means is that our asset has been fully depreciated, and the adjustment to the capital account in any year going forward will be equal to the taxable income less the distribution. Note that we did not include tax credits in the capital account, and we will explain why shortly. If we assume one partner, let's call them partner A, invested 60% of the required capital and they received 60% of all of the tax and cash benefits, each line item within the capital account calculations would just be equal to each line of the total partnership account multiplied by 60%. So the capital contribution would be 60% times 100 million, which equals 60 million. The sum total of taxable income over the entire life of the partnership would be 60% times 40 million, or 24 million. And the same for cash distributions, which equals 84 million over the project life. Partner B, however, putting in 40% of the required capital, will receive 40% of all of the benefits. They would have a capital account resembling the total partnership account multiplied by 40%. So you can probably see now how the two partner accounts of 60% and 40% respectively can be added together to equal the total partnership account and accounting for 100% of the total partnership. However, our partnership has disproportionate allocations which change over time following the flip. And the IRS imposes some rules limiting the amount of losses that any partner can take. And this is where Section 704B, capital accounts, come in, which David can explain.
Section 704B requires us to maintain capital accounts for the partnership in order for the allocations of the tax attributes to be respected for tax purposes. If we do not follow Section 704B, the IRS can try to change the allocation of the tax attributes. Obviously, the IRS cannot change how the partners decide to share the cash available for distributions. The requirements of Section 704B are, first, 100% of the partnership taxable income each year must be claimed by one of the partners. In the last example, partner A took 60% of the taxable income and partner B took 40%, totaling 100% of the partnership taxable income. Second, no partner takes losses or tax write-offs more than they have invested, subject to certain exceptions. Third, the transaction must have what's called substantial economic effect. Basically, we need to maintain something called Section 704B capital accounts, which governs what each partner is entitled to in a liquidation of the partnership. That is, the allocation of the profit and loss can be different than how cash is distributed, but the allocation of profit and loss govern the capital accounts, which govern what the partners are entitled to in a liquidation. We will look at both the Section 704B capital accounts and then something called outside basis, which we will define later. The purpose of the 704B capital accounts will ultimately be to check that no one partner has taken too much of the tax benefits from the partnership and to determine the actual taxable income each partner can take from the partnership.
We'll use our sample project to demonstrate 704B tax capital accounts with disproportionate allocations of tax attributes and cash distributions. The tax and cash allocations for our WIN project are just like we mentioned earlier. The tax equity partner will receive 99% of the tax attributes and 20% of the cash distributions for the first 10 years. And after that 10 years, the allocations will flip, and the tax equity partner will receive 5% of both the tax attributes and the cash distributions. And the sponsor partner is just going to receive the inverse of those benefits. The total partnership taxable income, or loss, and the cash distributions for the partnership that we calculated earlier are also shown right here on the screen, with a total income of $40 million over the life and distributions of $140 million over the life. Now, we need to allocate these losses and distributions into capital accounts in order to prove that one partner doesn't take out more from the partnership than they're permitted to take out. So let's model out the 704B capital account for the tax equity partner. Their account starts with an opening balance of 0, and we'll assume for now that they invest 60% of the cost of that project, or $60 million of the total $100 million capital cost in year 1. Now, allocated to them will be 99% of the taxable income, or losses, which is 99% times the $16 million in partnership loss, equaling $15.84 million. And then they'll take 20% of the cash distributions, which will reduce their capital account balance, leaving the closing balance at $43.36 million at the end of year 1. In year 2, again, they're going to be allocated 99% of the $28 million in losses from the partnership, and that will reduce their capital account by $27.72 million. And they will also be allocated 20% of the $4 million of cash distributions, or $0.8 million. So they will end with a closing balance in their capital account of $14.84 million. And year 3 will bring down, again, 99% of the losses of $15.05 million and 20% of the cash distributions, or $0.8 million, such that their capital account is now negative to the tune of $1.01 million. Now, what does this really mean? Well, due to the disproportionate sharing of tax and cash, the tax equity partner is taking losses, or they are writing off more than they invested, which is precisely what David said we can't do. And stepping back, this makes sense. Losses are the most influential line in the total partnership account. By the end of year 3, losses have totaled $59.2 million, of which the tax equity partner has taken 99%, or $58.61 million. And distributions have totaled $12 million in this same time period, and the tax equity took out 20% of this, or $2.4 million. So the tax equity investor put 60% of the capital in and took out 99% of the largest benefit. So of course their account is going to go negative. In year 4, we start with a balance of 1.01 million, and we are allocated losses of 99% of the 7.52 million, which equals 7.44 million. And again, 20% of the cash distributions, or 0.8 million, which takes our closing balance to negative 9.25 million. And this continues in year 5 and year 6, just increasing the value of the negative balance to the tune of 20.04 million by the end of year 6. However, once we get to year 7, the project has positive taxable income of $4 million because the depreciation period ended in year 6. So the tax equity partner will earn 99% of this income, or 3.96 million, and the balance in their capital account will increase from negative 20.04 million to negative 16.88 million. And this trend will continue through to year 10, with the balance gradually increasing over time. The flip occurs in year 11, which reduces the tax equity's allocation of taxable income and cash benefits. So with an opening capital account balance of 7.4 million, the tax equity partner will receive 5% of the $4 million of taxable income and 5% of the $4 million in cash distributions. And as taxable income and cash distributions are equal, the capital accounts doesn't change. It's just going to remain at that negative $7.4 million until the end of the project life. As a reminder, the line item with the single greatest responsibility for the 704B tax capital account going negative is tax losses. In the first 6 years, the losses were equal to 75.24 million before going positive to a total of 54.4 million. So tax losses are the single biggest driver of the negative balance of the tax capital account. And remember, the total partnership account never goes negative, but the tax equity partner's disproportionate allocation of the tax losses and disproportionate allocation of the cash results in a negative capital account balance for the tax equity partner. And we'll address how that works in just a minute. But first, the sponsor capital account is calculated exactly the same way as the tax equity account, but they take only 1% of the tax attributes. But remember how they invested 40% of the capital up front. So their account is going to remain overly positive. It's exactly the inverse position of the tax equity investor. And if we were to add those two accounts together, the tax equity investor plus the sponsor investor, what we'd find is those two sum to the total partnership capital account. Now, David, the negative capital account balance indicates that the tax equity partner is taking more losses than they invested, and you said this isn't permitted under Section 704B. So what are our options here?
Okay, welcome back. There's a number of good questions here, so we're going to pause for a minute before we get into deficit restoration obligations. The first question I will respond to. The question was, if the project performs poorly and it isn't forecast to ever reach the flip target, are there options for restructuring to get tax equity investors out? And again, some of these questions can be quite long, but sort of the basic structure that's not uncommon in these deals is, for this example of wind with PTC for 10 years, let's say we forecast when we did the deal to flip it 10 years, and we 2 years in we realize that actually that's not going to happen. What the common provision is that the tax equity investor will sweep a large proportion of the cash after year 10, and that could be 100% of all of the cash flow itself. So tax equity might walk away after 10 years getting all of the cash until they hit the yield that they required. And you can imagine from both the sponsor side that can hurt a lot, and even from the lender's side, because they only get the cash that's left over after that sweep. So that can be that helps the tax equity participant achieve their flip, but it certainly hurts the other parties. So that I'll pass across to David.
So, all right, thank you. We also had a question about the carbon credit recapture guidance that the IRS published on February 19th in the form of a revenue procedure and a notice. And the revenue procedure is 2020-12, and it's very much like the partnership flip safe harbor that we've been describing in the webinar today. Very similar to it. And then the notice is notice 2020-12, and that has start of construction rules that are very much like the start of construction rules we referred to in the beginning of the webinar, with the 5% safe harbor and significant physical work. One important distinction for carbon capture is that the IRS gave carbon capture projects 6 years to be complete, while renewable energy projects only have 4 years to be complete. So I'll let you speculate as to why carbon capture may have been treated more generously, excuse me. The other thing is that this is just the first round of guidance, and there is more guidance to come. In particular, the IRS did not address recapture. The statute says that if any of the captured carbon later leaks out, that the tax credits have to be recaptured. And the statute appears to have no time limit or any sort of proportionality in terms of how much leaked out to how many tax credits are recaptured. That has got tax equity investors very concerned. And I suspect that until the IRS clarifies the recapture rules, we're unlikely to see a financial type tax equity investor make an investment in carbon capture. But we may see parties come together to use this guidance who are more comfortable with the technology and might be investing otherwise, and use this guidance to optimize and make it more tax efficient. But in terms of the big tax equity banks, we don't think that's going to be we don't think that's going to happen until after we get this recapture guidance and some other points clarified. Let's see. Hayden, I think that was it for the questions we're addressing. Oh, one other question. I'm sorry. We also got this question about could the sponsor receive 100% of the cash distributions in the first year? And that is permissible. And in fact, in the IRS example in the Safe Harbor Revenue Procedure 2007-65, the sponsor in that example that the IRS published, in fact, does take all the cash in the first year. So as we've been trying to explain, the cash and the tax allocations are separate and do not have to follow one another. But there are various percentage limits we've referred to. Hayden, I think that is it for now. Do you want to continue with the video?
Yes, I will do that. Thank you, David.
Dan, that's correct. The negative balance isn't allowed, and this is where the substantial economic effect rules come into play. If a partner has a negative balance, it can, 1, allocate the loss to the other partner through a mechanism called a stop-loss limitation, or 2, provide a deficit restoration obligation, or a DRO, to restore the deficit balance to the partnership. This means if the partnership goes bankrupt when the tax equity investor has a negative balance in its capital account, it will be required to invest more money, adding insult to injury. The IRS in November published regulations emphasizing that DROs must have economic reality. For instance, the entity that provides the DRO needs assets separate from its interest in the partnership or to be guaranteed by an entity with other assets. Further, there needs to be restrictions on the transfer of the DRO, so the tax equity investor's interest in the DRO cannot just be transferred to a shell company when the project starts to go south. That all being said, I have never seen a DRO triggered in my career. And in a deal without senior secured debt, it requires some imagination to fathom what could go wrong with a project's operations so as to cause the DRO to be triggered.
We will start first with reallocations before we come to the deficit restoration obligation, or DRO. As David said, we wish to avoid negative tax capital accounts by reallocating losses from the tax equity partner to the sponsor partner. We only need to consider doing this when the account actually goes negative. So returning to our calculations and noting we have a positive closing balance in year 1 and year 2, we can start here in year 3. And in year 3, we have a negative 1.01 million closing balance, which we will call an interim balance for now. We need to avoid a negative closing balance by reallocating losses from this tax equity partner to the very positive balance sponsor tax capital account. Tax equity takes 99% of the losses in year 3, or 15.05 million, and the account balance is negative 1.01 million. So we want to reallocate this full 1.01 million of the losses back to the sponsor. And this is added to the capital account as we're removing the loss from the account itself. And this is also often called a stop loss limitation, rather than the label we have here saying reallocation to sponsor equity. And immediately below this line, we have a reallocation from the sponsor equity line. If the sponsor 704B capital account went negative, the sponsor would reallocate losses back towards the tax equity partner. Although this is really unlikely in our example, or mostly in practice, given the sponsor equity 704B capital account is so positive. The new closing balance is a negative 1.01 million plus the reallocation to sponsor equity of 1.01 million, and that equals 0. We have achieved the goal of a 0 closing balance. But this has come at a price. Let's look at the taxable income to the tax equity partner. In years 1 and 2, tax equity receives the full tax loss of 15.84 million and 27.72 million respectively. And in year 3, the initial loss was 15.05 million, but we reallocate away 1.01 million of this to the sponsor partner, leaving the taxable income for year 3 as the 15.05 million less the 1.01 million, or 14.04 million. The full 15.05 million loss was a benefit to tax equity, which they no longer receive, as under the Partnership Tax Rules Section 704B, they are taking out more of the losses than they are permitted to. And it's even worse. If we are reallocating away the losses to the sponsor, the PTC will also be reallocated away. And this is the most important aspect from a deal economic standpoint. And we'll see the impact of this later. The year 4 only balance is now 0, and the interim balance is negative 8.24 million. We need to reallocate 8.24 million in losses to the sponsor in order to maintain a 0 capital balance. But tax equity only receives 7.44 million of losses, with the remaining 0.8 million of the total 8.24 million negative interim balance being from cash distributions. And we can only reallocate the total losses in the year allocated to tax equity, which is 7.44 million. So adding this 7.44 million to the 8.24 million interim balance, the closing balance is still negative to the tune of the amount of the distribution tax equity receives being negative 0.8 million. This negative balance will need to be resolved, but we will come back to that shortly. The main takeaway here is that we are reallocating losses and tax credits from the tax equity investor to the sponsor to avoid a negative account. But we can only allocate up to the amount of losses the tax equity actually receives in that year. Since all of tax equity's losses are reallocated to the sponsor, there is no taxable income or loss for the tax equity partner in year 4. And in year 5, it's very similar to year 4, that we reallocate all of tax equity's 7.44 million of losses to the sponsor. But due to distributions, we are further decreasing our closing balance by the amount of distributions of 0.8 million. The negative capital account balance increases further, or decreases, to negative 1.6 million. Our taxable income is again 0, as we have reallocated all our losses to the sponsor partner. In year 6, it's the same as year 4 and 5, and leaves a negative balance of 2.4 million, and of course no taxable income or losses for the tax equity partner. In year 7, we start with a balance of negative 2.4 million, and we have a positive income of 3.96 million, given that the depreciation is now being fully utilized. The interim balance is now 0.76 million, and we don't need to reallocate to the sponsor given we don't have any losses. And the closing balance increases to negative 0.76 million. Tax equity receives all of the income of 3.96 million, given that there are no reallocations. As we copy this across the remaining years, the capital account continues to increase until year 10. From year 11 to the end of the project, year 35, the account balance remains flat as the EBITDA equals the taxable income, and tax equity receives 5% of both cash distributions and the tax benefits. So what's this telling us? Taxable income for the tax equity investor increased from 32 million to 49.64 million over the life of the project with reallocations, because we moved 17.64 million of losses, or the negative income, to the sponsor. This reduced the losses to the tax equity investor by nearly 25%. And since this is such a big part of the benefits to tax equity, this just isn't a good situation for them, and would ultimately result in the tax equity investor committing less capital, meaning more is required from the sponsor. And DROs can help here with this, and so for this reason, they're commonly adopted in tax equity transactions.
In lieu of reallocation, or in addition to reallocation, a tax equity partner can provide a deficit restoration obligation, or DRO, whereby in the event the partnership is liquidated, the tax equity investor must make a capital contribution sufficient to bring its capital account to zero. Typically, a partnership would only be liquidated if there were a creditor owed a debt that exceeded the partnership's means to pay, which is unlikely without a senior secured lender. Alternatively, the deal could be structured to slow down tax and/or cash allocations to the tax equity investor until the capital accounts return to zero. This works well in solar deals, where, as we mentioned earlier, the tax benefits may be stepped down to 67% after year 1. ITC is front-ended all in the first year, and with the tax credit being the largest benefit for the tax equity investor, the allocation of the tax equity can be reduced after receiving the ITC to avoid the capital account going negative. The tax equity investor forgoes some tax losses, but overall the economics stack up well. But for wind, this approach doesn't work so well. PTC is the largest benefit, and it lasts 10 years. The tax equity investor doesn't want to forgo its allocations of PTCs, so reducing the allocation wouldn't be beneficial for the tax equity investor. For instance, it would be inefficient for a tax equity investor to only be allocated 67% of the PTCs in years 2 through 6, as that is 32% less than it's entitled to be allocated under the safe harbor. The IRS views electricity as a good rather than a service. Accordingly, cost of goods sold accounting must be used similar to the tax accounting that Ford uses for cars it makes, whereby depreciation is capitalized into the cost of goods sold. This sounds like a mouthful, but it basically means that profit, loss, and tax credits must be allocated in the same percentage. However, in some solar deals, cost of goods sold accounting is not applicable if the underlying customer agreements are leases. That is because in a lease, the customer is paying for the use of the project rather than paying for electricity. Leases can arise in residential solar deals, in which some residential customers prefer to lease than to enter into a power purchase agreement. It can also arise in certain jurisdictions, for instance, South Carolina, where only a utility company may sell power. Accordingly, residential and commercial and industrial customers may only lease solar projects. When there is a lease, there is the option to allocate tax losses in one manner and rental income in another manner. Leases do not arise in PTC deals because the PTC statute prohibits leases for wind projects. The DRO avoids the reallocation of losses from the tax equity investor to the sponsor. However, it is important to note that does not mean the DRO will allow the tax equity investor to currently deduct those losses. This will be covered later in our discussion of outside bases. So DROs are really more about tax credits than they are about currently deducting losses. Each tax equity investor has its own way of sizing the maximum DRO it is comfortable providing, but the DRO is typically stated in terms of a percentage of a tax equity investor's total investment. For wind, the DRO is typically sized between 35 to 45% of the tax equity investor's total capital contribution, while it is typically higher for solar and in some instances a good deal higher for solar. I will pass back to Dan to explain the calculations.
From a calculation standpoint, the DRO will be used first to absorb the negative 704B balance, and we will only reallocate losses to the sponsor to the extent the DRO can't absorb the negative balance itself. So let's start from the beginning of year 3, as in year 1 and year 2, we have no reallocations and a positive capital account balance. The interim balance in year 3 is negative 1.01 million, exactly as earlier, and we've sized the DRO at 30% of the investment size, which is 30% times the tax equity partner's investment of 60 million, which equals 18 million. This is slightly lower than is common in the market in order to just demonstrate the mechanics. The closing balance of negative 1.01 million is less than the $18 million DRO limit, so the DRO can effectively absorb this negative balance. And this means that the tax equity partner can use all of year 3's losses, being 15.05 million, instead of reallocating some of those losses to the sponsor. The taxable loss to tax equity is 15.05 million. Now, however, if the partnership were liquidated at the end of year 3, the tax equity investor would need to pay in capital or actually invest 1.01 million to bring their capital account back up to 0. Year 4 starts with a capital account balance of negative 1.01 million with an interim balance, as before, of negative 9.25 million. This negative 9.25 is still lower than our DRO limit, and so there's no need to reallocate losses to the sponsor, and tax equity gets the full 7.44 million in losses. Year 5 works the same as year 4, ending with a balance of negative 17.5 million, which is just below our DRO limit of 18 million. But year 6 starts with a negative opening balance of 17.5 million, and once losses and cash distributions are subtracted, the interim balance takes us down to 20.04 million negative, and this is higher than the DRO balance by 2.04 million. So now we've got a problem. We need to reallocate the 2.04 million, but tax equity only has 1.74 million of losses that it can reallocate, which leaves the closing balance at negative 18.3 million. And now that absolute value of 18.3 million is greater than our $18 million DRO limit. And this is an issue, but we'll come back to it in a couple of minutes. As the tax equity investor reallocates all of the losses to the sponsor, their taxable income is 0 for the period. Taxable income will become positive in year 7 because we're after the end of the maker's depreciation period, and the capital account balance is only just going to increase from here until we hit the flip, when it will again become constant until the end of the project life. So what has the DRO achieved? Well, first and foremost, it avoided reallocating a large portion of the taxable losses to the sponsor, meaning that those losses are available for the tax equity investor once it's allocated that income by the partnership. And this is going to increase the present value of the losses to the tax equity investor, which ultimately means that the tax equity investor is going to be willing and able to invest more capital and still achieve the same after-tax return. And more on that later.
Unfortunately, the negative account balance is still greater than the DRO in year 6. We have a number of options here to address this. First, we can increase the DRO limit to 18.3 million, so there are no reallocations to the sponsor. This means the tax equity investor would be on the hook for 0.3 million more in the case of a liquidation of the partnership in year 6. Second, we could reallocate the excess of 0.3 million of losses to a sponsor in year 5 to get the balance to a maximum absolute value of 18 million in year 6. In a PTC deal, this would mean a corresponding reallocation of PTCs to a sponsor. Such a reallocation reduces the tax losses available to the tax equity investor, reducing its return and thus the capital it can invest. Third, as cash distributions are subtracted from capital accounts, another option is to reduce the percentage of cash distributed to the tax equity investor. This reduces cash to the tax equity investor but increases the tax losses available for it. However, as the economic benefit of a tax loss is 21 cents on the dollar, tax equity investors are generally not prepared to trade tax losses at 21 cents on the dollar for distributions worth 100 cents on the dollar. Or fourth, increase the amount of capital invested by the tax equity investor from the start, which this would then reduce its internal rate of return. Either way, without a higher DRO limit, the tax equity investment will be less efficient, and the tax equity investor will be unable to absorb as many losses, having to agree to lower cash distributions or having to agree to invest more upfront. Well, what are we trying to do here? Maximize the benefit of losses to tax equity so it invests more. The challenge is that the tax equity capital account trends negative. This also explains why 100% bonus depreciation in year 1, sometimes called expensing, is generally avoided in deals in which the tax equity investor provides a DRO, as the account trends even more negative. Which option to select will depend on the detailed analysis for your project, and there is huge value in a good advisor for this analysis.
We have thus far assumed that the sponsor can absorb all of the reallocation of losses from the tax equity partner. And so taking a look at the sponsor partner's Section 704B capital account, we can see that the account remains positive throughout. So the sponsor is able to absorb the losses. And this makes sense as they invest only 40% of the capital and only receive 1% of the losses, pre the flip. And you will note that in year 6, the reallocation from tax equity is 1.74 million, and that's added to the taxable losses of the sponsor partner, increasing their losses from 0.2 million to 1.76 million. This is of benefit to the sponsor, but assuming they're an inefficient taxpayer, it will add the 1.76 million to its tax loss carried forwards and get the benefit in later years, not in this year. In contrast, a tax equity investor typically has taxable income from other operations that allow it to use all of the losses and tax credits allocated to it in the current year. The sponsor takes only 1% of losses but receives 95% of the positive income from year 11 to the end of the project in year 35. So its cumulative taxable income is 92.66 million, much higher than the cumulative taxable income to the tax equity investor. And recall that David said 100% of the partnership taxable income each year must be claimed by someone, either the tax equity investor or the sponsor. We need to check this to ensure our capital accounts are correct. The total taxable income for the project is 40 million, shown in the total partnership 704B capital account. Bring in the tax equity partner's taxable income we calculated earlier of negative 52.66 million, and adding that to the 92.66 million of taxable income from the sponsor gives us 40 million. It's the same as the total partnership's taxable income. This means we've allocated all of the taxable income and losses across the partnership, and we're satisfying the rule David mentioned. And finally, note that the tax credit has not been included. The purpose of the Section 704B capital accounts is to determine reallocations and taxable income for both the sponsor partner and the tax equity partner. The tax credit is a dollar for dollar offset of the final tax bill to the specific partner, so it doesn't belong in the capital accounts.
It is also worth considering the differences for solar projects and wind projects. There are two fundamental differences without going into the more granular details. First of all, when using ITC, For instance, in a solar project, we need to reduce the depreciable basis by 50% of the value of the ITC. Assuming 100 million of eligible CapEx and a 30% ITC, the ITC itself is 30 million. Our total 704B partnership account basis would reduce by 50% of this, or 15 million in year one. And the tax equity investor receives 99% of this, called an ITC basis reduction. You can see the year one closing balance is lower than the wind project by the ITC basis reduction amount. This exaggerates the issue of the tax equity investor's negative capital account. And this leads us to a second major difference. The negative account balance means that the reallocation is a reality, and it is a prime reason that the tax allocation reduces down from 99% to 67% in year two. Why in year two? Well, the tax losses are valuable, but the ITC is the most valuable item, and the tax equity has received that in year one. Now, let's talk about outside basis. The Section 704B capital account recorded based on what the tax law calls book value of the project, which is based on the fair market value of the project and not dependent on the tax basis of the property that a partner may have contributed to the partnership. For instance, if a partner contributes land of a fair market value of 1 million and a tax basis of 0, its capital account is increased by the book value of the land, or $1 million. This book value is not to be confused with GAAP, as it may or may not be the same number for GAAP purposes. Section 704B capital accounts and their use of book value is a way of measuring what each partner has contributed to the partnership economically and what each partner has withdrawn from the partnership economically. This is required to ensure that the allocations have substantial economic effect and can withstand an attack by the IRS. In addition to the capital accounts calculated for 704B purposes, we also need to calculate outside basis. Outside basis is dependent on tax basis. For instance, the partner who contributed the partnership the land with a fair market value of 1 million and tax basis of 0 takes an outside basis in the partnership of 0. What's important is that this is the basis which will determine the actual taxable income to each partner for purposes of tax payments owed to the IRS.
As the outside basis tax capital accounts are for the purpose of calculating tax to the partner, we start with the 704B taxable income or losses to the partner after reallocations. If the losses have been reallocated to the other partner, they're no longer available for this partner to use. The tax equity investor's taxable income from the Section 704B account calculations is 52.66 million after reallocating the 1.74 million to the sponsor. The capital account also includes the investment of 60 million because $60 million of cash today is worth the same today to the partnership as it is to the partner, and it's the same for distributions. So the initial capital account we have here is identical to the Section 704B account. However, the main difference is that the outside basis capital accounts are not permitted to go negative ever. The question is, how do we deal with this? And David can clarify the rules here.
You're right here as always, Hayden. Negative outside basis is not permitted in outside basis capital accounts. Instead, Section 704D requires that we must suspend the losses, carrying them forward until the account has a positive value, which only happens if the partner has allocated taxable income without a corresponding distribution of cash.
We don't get to a negative capital account balance until year 3, so let's start there. Our outside basis capital account is negative from year 3 to year 6, after which it turns around and becomes positive. So we will suspend or accrue suspended losses to the value of the negative account until we can use them when the account becomes positive from year 7 and onwards. And as David mentioned, this requires an allocation of taxable income without a corresponding distribution of cash. So let's start our calculations in year 3, the first year of our negative balance. The capital account has an interim balance of negative 1.01 million, And we have created a suspended losses control account beneath the capital account. The suspended loss account itself is not a part of the capital account. It's just used to see the volume of suspended losses at any one stage. You can think of it sort of like you'd think of how you track net operating loss carryforwards if you create an NOL carryforward account. The logic is if the interim balance, and what I mean by that is the balance before suspending losses, is negative, we will add to the suspended losses account. And in year 3, the interim balance is negative to the tune of 1.01 million, so we will add this to our suspended losses account. And this 1.01 million suspended loss is then added also to our outsized basis account as a suspended losses adjustment. And as the interim balance is negative 1.01 million and our suspended loss is a positive 1.01 million, the closing balance on the outside basis is the sum of those two. So it sums to 0. And now we've removed the negative balance by taking the interim balance loss up into our suspended loss account and removing it from the capital account. Now, our starting balance in year 4 is the closing balance after the suspended losses adjustment, and that equals 0. So rather than the negative 1.01 million that we had before we were suspending our losses. After losses and distribution, our interim balance is negative 8.24 million. So again, we have to suspend all of this loss, increasing our suspended losses account by 8.24 million, up to now 9.25 million. We'll then add the suspended loss adjustment to the capital account, which creates a 0 capital account balance as we're suspending all of the capital account losses. And year 5 is going to function exactly the same way as year 4, starting with a 0 balance as we suspended all of our previous losses. So again, we will increase the suspended losses by 8.24 million up to 17.50 million, and we will maintain a 0 account closing balance. And we're continuing to meet those rules that David described on keeping our balance 0 or positive. So now in year 6, we will start with an opening balance of 0, and the losses in this year have been reallocated to the sponsor, so we only have the 0.8 million in cash distributions to get an interim balance of negative 0.8 million. And as we still have a loss position in the capital account, we add this 0.8 million to our suspended losses to get a total of 18.3 million. And this 18.3 million should sound familiar. It's the maximum negative balance in the 704B capital account. Remember? But instead of allowing the outside basis to go negative, instead we built up our suspended losses to that equivalent amount. In year 7, we have positive taxable income of 3.96 million and distributions of 0.8 million. So our interim balance is positive 3.16 million, and we no longer need to suspend any of our losses. And just like the net operating loss carryforward account, we can start using up or consuming our suspended losses. So we're going to consume 3.16 million of suspended losses to reduce our suspended loss balance account to 15.14 million. So we'll also subtract this 3.16 million reduction in suspended losses from our capital account to end with a balance of 0. And this is the same in years 8 through years 10. We're constantly reducing the remaining suspended losses. In year 11, things change. The balance is going to remain constant as taxable income equals the same as our cash distributions, and our allocations for both are the same. So the interim balance going forward is just going to be the same in every period from here, as we have no further ability to use up the suspended losses. And that's a shame, as we don't use up all of the suspended losses, which means that 5.66 million of losses are trapped. And this is inefficient, and a core role of our financial advisor or tax attorney is to structure our deal in a way that avoids this problem. So what has the outside basis calculation really done? Well, we calculated our taxable income and our losses available to the partner for purposes of their tax calculations. We start with the Section 704B taxable income or loss of some total of $52.66 million, and we added suspended losses when the account was negative, and we consumed those suspended losses when the account was positive. So basically, the suspended losses just pushed out the timing of our losses, but because there is a time value of money, delaying losses reduces the net present value of this investment to the tax equity investor. Now, you may see a pattern in the numbers on the screen too. We have losses until year 3, after which taxable income is the $0.8 million, the value of the cash distribution received. And this is because we're removing all of the losses from the capital account into the suspended losses account. We'll then be using all of that positive income to reduce the suspended losses, offsetting one by the other. And this pattern is common until either after the flip or when all the suspended losses have finally been consumed. And after that point, the taxable income will, on an outside basis, equal the taxable income on the Section 704B basis. It's important as a financial modeler or someone who reviews the models to start seeing these patterns. All of this, of course, is assuming that all of our suspended losses can ultimately be consumed, meaning that the total taxable income or loss between the Section 704B and the outside basis would be equal, albeit with different timing because of the way suspended losses push that out. And that's the goal of financial structuring. The sponsor outside basis is calculated in exactly the same way. But as we saw earlier, our account will never go negative, so there are not going to be any suspended losses, and the 704B taxable income will be identical to the outside basis taxable income. The note of difference here is that an inefficient taxpayer will need a net operating loss account.
To be complete with respect to these calculations, there are some additional items we would also need to model. Those are Section 731A gain, Section 754 elections and the associated step-up, and resulting depreciation from the Section 754 step-up. We won't show the values in the webinar due to time constraints, but these concepts are as follows. Section 731A provides the following. An advantage of a partnership is that a partner can receive cash without tax, so long as the partner has outside basis to absorb the cash. However, once the partner's outside basis reaches 0, then the cash distribution it receives are taxed as taxable income. Or in other words, from a tax perspective, there is a check to ensure that a partner pays tax if it is distributed cumulative cash in excess of its capital account, plus the net losses and taxable income it has been allocated. Once a partner exceeds that limit, the partner has additional taxable income without regard to the tax profile of the partnership. For this reason, such a distribution must be recognized as a gain, which we call a Section 731A gain. It is added to the partner's outside basis. When a Section 731A gain is added to the outside basis, it is comparable to the partner who received the cash distribution to buying an incremental interest in the partnership. Then, if the partnership has made what is known as a Section 754 election, that deemed purchase can result in an increase to the basis of the partnership's assets and a corresponding increase to the partner's capital accounts. But Section 754 step-up is considered a gain from a Section 704B capital account perspective, and that gain is depreciated, increasing the losses that the partnership has to allocate to its partners. Most commonly, those losses are calculated on a 15-year straight-line basis, amortizing that gain. So that results in additional depreciation for the partnership that will flow through to the partner's Section 704B accounts and their outside basis. You can see this is a little challenging as there's now an interdependence between the Section 704B accounts and the outside basis.
We've covered many topics and looked at a lot of numbers. And in our tax equity course, we cover this in further detail. But here is a quick recap before we come to why these accounts are just so important for not only tax equity, but also for sponsors to understand. And we'll also talk about some important key insights. Firstly, tax credits are the biggest drivers on those deals, with the largest part of the value to an efficient taxpayer being the tax credits. And these are being legislatively phased out in the case of PDC and being phased down in the case of ITC. Secondly, tax losses are also highly valuable to an efficient taxpayer. And capital accounts are required in order to ensure one partner doesn't take out more from the partnership than permitted, and such that someone takes all of the income or the losses from the total partnership. Thirdly, cash also clearly has a benefit, but tax equity investors generally prefer tax credits to cash, as tax credits are not subject to tax, while cash ultimately is subject to tax at some point. Further, many companies view the prime role of their tax equity investment arms to be reducing taxes, and the core operations of the company are for the cash generation part of the business. So to get the tax calculations correct, which is so important here, we start by building the Section 704B capital accounts. And the purpose of that is to size the DRO and/or reallocate losses to the other partner. We then add to that the outside basis capital accounts. The purpose of this is to determine the tax benefit or the cost to the partner. And these accounts cannot be negative. So we have to suspend losses when they are negative and use them up when the account is positive. Finally, we need to add the Section 731A gains and the 754 step-ups, as David mentioned.
You know, we focused so much here on the tax equity investors capital account, and this is deliberate. The tax equity investors capital account are the ones that need the most massaging. It's the account that has the possibility of going negative. But if you're the sponsor, you really need to know and understand these accounts. And also, if you are a lender providing back leverage to the sponsor, it's critical that you know and understand these accounts. If the economics of the project are such that you're going to need tax equity, then it is in your interest to ensure that the tax equity investor is as efficient as possible. Many tax equity participants will size their commitment based on a present value. And the less reallocation to the sponsor and the less suspended losses, the higher their present value, or the higher the amount that they will invest. And if tax equity invests more, then you as the sponsor will be able to invest less, and that should increase your returns. In the model that we've just presented, if we use a 7.25% discount rate for tax equity, their present value is around $55 million, which is less than the $60 million that we assumed they were going to invest. And if you think about this, it will only lower our tax basis, requiring more thought and structuring that we just don't have time to do here. The tax equity is the most expensive after-tax form of capital in the capital stack. So helping them to be efficient is really important. Tax equity is not a cheap source of capital, especially for the risk that they take on compared to the sponsor. And in our next webinar with Cohn Resnick, we'll be looking at the risk and the return under different assumptions between tax equity and sponsors.
This whole capital account and tax efficiency arose because of the disproportionate allocations between investment size to the tax benefits and the cash distributions. And it's really hard to get right, which is why we need good financial and legal advice, speaking to people like David Burton. So let's for a second say that you're a tax-efficient investor who's also interested in renewable energy project investments. So you're willing to buy 100% of an asset. In an earlier example, with our partner investing 60% of the project cost and receiving 60% of all of the benefits, they didn't have any tax capital account issues. They were really efficient from a tax perspective. They can use all of the losses now. There's a sort of an arbitrage to someone who's willing to invest for all of the tax benefits as well as all of the cash benefits.
This webinar is focused on PTC tax equity partnerships, but provides only a taste for the issues and structuring options associated with ITC transactions. For instance, there are many ITC deals executed with flips that occur on a fixed date regardless of the performance of the project, and the investor is not concerned about its after-tax IRR, but rather invests based on the ratio of investment to the ITCs allocated to it and does not use a DRO. In addition, there is a menu of other structuring options available in ITC transactions. Those include sale leasebacks, pass-through leases in which the lessee claims the ITC under a special statutory election, and the inverted lease in which the lessee is a partnership between the sponsor and the tax equity investor. The lessee claims the ITC under that special election, and the lessor is a partnership between the lessee and the sponsor. Therefore, this webinar just scratches the surface of the structuring options available.
Okay, just going to hand quickly across to David to say a couple of things before we go into a little bit more Q&A. So David, do you want to pick up?
Yes, thank you, Aidan. So appreciate everybody's time. If there are questions we have not answered, I will answer them in a couple of days on my blog. That's taxequitynews.com. So you for answers there in a couple of days to the questions we didn't get to. Also, we have all three of us have been contacted by companies that are interested in expanding their staff with expertise in this area. So that if you are experienced in this area and could be interested in a new opportunity, feel free to reach out to any of us, and we will connect you to one or more of the companies that have said they need help growing their expertise here. Because these are challenging issues, and we've only just touched on the surface of many of them, but there are similar pivotal 180 seminars coming up that go into more detail. So Aidan, back to you.
Thanks, David. Okay. I've mentioned a few times first around the next webinar with Pivotal 180 and Korn Resnick. I'm not sure anyone who's received an invite to this webinar. We will make sure that we send out a link to that, but you can go to the Pivotal 180 website and just register directly for that webinar and subscribe to that mailing list as well. But there's the two webinars, as I mentioned. One sort of around renewable energy project finance modeling, what are the key scenarios that you need to run, and also around asset management modeling. We tend to focus a lot on deal modeling, but actually, the real work begins once we, and operating our project. So we need to deal with financial models in a nice, easy way and help the asset managers perform their analysis. The second one is about risk of tax equity transactions to different parties. So we'll go through that. There's still so many questions. As David said, we will ensure that they are answered on David's blog. There is a host of things. And someone just asked again, the question is linked to where you can register for the next webinar. Go to the Pivotal 180 website. We will send a link out on that so you can sign up. Clearly, there's a lot more detail here, and the importance of good advisors like David Burton is critical. But there is some other options. I mentioned the book earlier, but Pivotal 180 also runs courses. So we run them in person. So you can see the schedule on screen. There's 3-day renewable energy financial modeling courses, which cover not just modeling, they also cover the key documents, PPAs and facility agreements. It's more than just the modeling itself. And then tax equity 1-day course, which is a follow-on from that, which covers more detail than we managed to cover here as well. So there's that opportunity for you. In addition to that, we also tailor courses at Pivotal 180. So we can come to your organizations and do very tailored training. It could just focus on capital accounts and 731A gains, or it could be a broader course. We cover renewable energy, infrastructure, mining, sort of all the general project finance sectors, as well as general financial modeling training as well. So, you know, we do in-person courses. They're very highly tailored, even to the extent of building in the local tax code of wherever you're based. So we can do that. We also do some consulting work, and if you'd like to speak to us about that, you can do so. The video will be made available after the webinar. Had a lot of questions about that, so we'll send a link out so you can watch it at your own time, pause it, watch it, absorb it. There's a lot of stuff here, and we apologize it went over a bit of time, but thank you. And I forgot to mention, in the tax equity modeling course, it goes beyond just the tax capital accounts that we run. It also goes to HLBV, and many of the questions people have asked today. There's been a huge turnout for this webinar, and so just a very large number of questions. We thank you for being so interactive with us. With that, I think we will end, unless, Dan, you have anything to add?
No, thank you so much for your engagement, your time, your patience with us, and we hope you learned something valuable.
Okay, well, thank you, everyone. Have a good day. Sorry it went a little bit long. Hope to see you around. Thank you.